Good morning.
Good morning. Good morning.
Morning,
Hey,
Professor.
Steve.
How are you?
Good. How are you doing?
Good.
Good. Hey, Thomas.
Good morning, Professor.
Good morning. How are you?
I'm good. I'm good.
Good. Good. Let's get started in just a minute.
How you doing, Professor?
Hey, Michael. Good. How are you?
Good, good.
Well, good morning. Thanks as always for calling in. Let's get started. I received, first of all, thanks for completing the exam. I received it from everyone who's here, so that's great. Thanks for doing that. I'll have it back to you. It was due at midnight last night. I should have it done, graded, and back to you by tomorrow, I think. And I look forward to checking that out. Let's look what's going on in the rest of the class here. Let me share the Chrome web browser. Let's see, so we've been doing a pretty good job on the mini exercises, submitting those. We've got one associated with today's content. So if you take a look at today's videos, there's a simple exercise that's due Sunday. Shouldn't be too bad. And then our next assignment is up on Blackboard under assignments, assignment 4. And it's about bond duration and interest rate risk management, which is this next part of the class. And the assignment's due April 16th. So if you can keep up with what's going on in the class over the next few class periods, you should be fine with the assignment. It's very similar to what we're working on the spreadsheets. So that's that on the course. Any questions about anything before we start? Questions now? All right. Well then, let's, oh, there's a chat. Remember, I can't see the chat very well, so feel free to speak up. Okay, thank you, Victoria. No questions. All right, well, let's have a brief talk about duration and interest rate risk management, because it's an interesting time in terms of bond portfolio management, because interest rates are at pretty much zero right now. And so just about the only place that interest rates can go is up in the future. I suppose it's theoretically possible for us to go into negative interest rate territory. That'd be really weird here in the US. But you know, my bet is eventually interest rates are going to go up. I have no idea when. I'm sure I wouldn't imagine it's anytime soon. But when that happens, bond values are going to decline, right? Because bond prices and interest rates move in opposite directions. How do we manage interest rate risk? And let me just share the slides just real quick, and then we'll go from there. I just want to emphasize, I mean, you saw all this in the videos if you've taken a look at them, but as we think about managing interest rate risk, right, sensitivity to changes in interest rates, there's really 3 measures of duration that we're going to have to keep straight. So Macaulay duration, this is actually related to the first derivative of the bond price function. If you're interested in math and how bond prices change as interest rates change, one idea would be, well, you know, if you want to measure something like that mathematically, how does a bond price change as the discount rate, as R in this formula, changes? You could take the derivative of this function with respect to R, right? And see how the price changes, see how the price changes as the discount rate changes. And that's kind of what that's exactly what these duration measures are sort of built on. What's the first derivative of the price function, right? If we differentiate this with respect to R, we come up with a rate of change in price for a given change in discount rate. And that's what duration is mostly about. But just to review a couple duration measures, right? Macaulay duration is kind of a weighted average maturity. What percent of a bond's cash flows occur at different points in time? So like a 10-year bond will have a duration of less than 10 years because you receive some of the cash flows from the bond sooner than 10 years, right? And then modified duration I find to be really a good, I think a more intuitive measure of interest rate risk, right? Because it's kind of like an elasticity. Benninga calls it the price elasticity of a bond, which I guess if we like elasticities, that's an okay term. But it's going to be important to me that you can interpret this modified duration measure. Like if a bond has a duration of 3.5, what is that? If a bond has a modified duration of 3.5, can you tell me what that means in words? And let's see, can you tell me that now? So if a bond has a modified duration of 3.5, what does that mean in words?
Yep, Professor, I have a question because I was watching the videos, and it means that the price decreases by that or something like that. And I didn't understand it, so I had a question about the modified duration. What does it mean in a blank? Because in the video it was like 3.5 or something percent of decrease in the price. And I didn't really understand that to the yield, like yield to maturity.
Yes. So yeah, okay. Well, let's hash it out now. Anybody else want to take this one?
I'll give it a shot. So I remember it was like if the yield to maturity increases by 100 basis point, which is 1%. It's like, is it like percentage or dollar? I think it was like the price would decrease by 3.5%.
Exactly. Yeah. Modified duration, D star, in the notation of our class. And if interest rates rise by 100 basis points, right, that's 1%, the bond's price will decline by 350 basis points, or 3.5%. Maybe I'll write it in percentages just because that's maybe more straightforward. Right? Or if the bond's yield to maturity, if the bond's discount rate rises by 1%, like from 8% up to 9% by 1 percentage point, the bond's price will decline by 3.5%.
So is that better when the interest rate rises or decreases?
Let's see. So is this good? I guess. So yeah, I get if your question is like, is it better to have bonds with more duration, like more interest rate risk or less interest rate risk?
Yeah.
Because
like the bond's price would decrease. So do you want the bond's price to decrease?
If I own a bond, I want the bond's price to go up over time. Right?
Okay. So
yeah.
So the interest rate. I think I'm sorry. No,
and then, by the same token, if interest rates fall by 1%, this bond's price will rise by about 3.5%. So I guess the question is more duration good or bad? Depends on how we think interest rates are going to change in the future. Right? it's kind of like, oh, are high beta stocks better than low beta stocks, or are low beta stocks better? Well, it depends on what you think the market is going to do. If you think the market is going to go up, then we should invest in high beta stocks, because those stocks will go up even more as the market goes up. If we think the market's going to go down, we want low beta stocks. Same with duration, right? If we think interest rates are going to rise, meaning bond prices will fall, we should probably have short duration or low duration bonds with less interest rate risk, because if interest rates rise, then bond prices fall. So like if I think I don't, but if I think interest rates, hypothetically, we're going to rise by 2 percentage points over the next year, I would much rather have a bond with a duration of 1 than a bond with a duration of, oops, it's saying my internet connection is unstable. Let's see if it stabilizes. Let me say that again. So I think interest rates are going to rise a lot. I'd much rather have a bond with a duration of something like 1 than a bond with a duration of something like 9, right? Because if interest rates go up by 1 percentage point, a bond with the duration of 1, its price declines by 1%. A bond with the duration of 9, its price declines by 9%.
So interest rates, like at the moment, are low?
Yeah, they're pretty much very close to, I mean, the federal funds rate is close to 0. So that means that, like, as that rate goes up and down, discount rates on all kinds of investments go up and down. So like when the Fed lowers interest rates, usually bond discount rates decline with it. There's other factors that go into like what a bond's yield to maturity is, but one big thing is what the current level of interest rates is. The federal funds rate. So, good questions. Good talks. Any other questions right now? All right, well, let's talk about one more duration measure, and then if you've got specific things you want to go over, we can. But otherwise, yeah, we'll take it from there, right? So modified duration measures price sensitivity in percentage terms. Dollar duration measures price sensitivity in dollar terms, right? So how much does a bond's price change in dollar terms for a 1% change in interest rates or a 1% change in yield to maturity? So maybe just one illustrative example, and then we can see where we're at. Let's see, suppose I own a bond position. Suppose I own a bond, or suppose my bond portfolio has a dollar duration of something like 55,000. Let's interpret that in words. What does that mean in words? What does that mean? Good. So what does this mean? Good reinforcement of these duration measures, because we'll be working with them. Should we invoke the random participation spreadsheet? Oh, you know what? I don't think I have access to it because I have to be on the campus network to do it. But we could do a short iteration of it, I suppose. Let's try it. Gonna earn the participation points. Thanks as always. Thanks for dialing in. Alrighty. So just building the spreadsheet real quick. Thanks for your patience. I'm gonna share it with you in just a little bit. Totally gonna be worth the wait. see. Let me just make sure I'm sharing the right one. Oh yes, it's book 3. Here we go. All right, so let's generate a random number between 1 and 7 and 16. Remember, the question is, if a bond portfolio has a dollar duration of 55,000, what does that mean in words? Gunnar, are you with us? Let me see the list. He is. Gunnar, can you hear me? Earth to Gunnar? Nope, all right, let's try someone else. Thomas, you did the last one, so don't do this one, okay? Oh wait, no, Michael, you did the last one. All right, give it a go, Thomas.
Does it mean a 1% increase in yield to maturity is like a 55,000 decrease in price?
Exactly, yeah, a $55,000 decrease in the value of my bond portfolio. Right, if interest rates rise by 1%, my bond portfolio will decline in value by $55,000. Nice, Thomas.
That's a big decrease.
Will it always be 1%, or is that just for this example?
Yeah, that's usually how it's usually how we measure it. I mean, interest rates don't usually change by 1% at a time when they change. So, but if we just want to say, if we just want to use this as a measure, I usually interpret in terms of a 1% change in interest rates. So you could say, well, if interest rates rise by 2%, well, then that's associated with the change of $110,000 and so on. But yeah, that's a good question. But we usually like interpreting it, it's just in terms of 1 percentage point change. Okay, nice. Any other any questions right now? Questions? So I'd be sure to, as we learn about duration and interest rate risk management, as always, I think it's worthwhile to work through the spreadsheets and try to build them as you go along with the videos. If you've got questions about that or want to go over your work with me, let me know. I'm happy to help you out there. So let's see. That's what I wanted to cover today. If anybody wants to look at like more specific things, I'm happy to take a look at those. But or if you have questions. So
I got questions from the short sales.
Okay, sure.
From the before I had a question. Is there short sales going on now because like the stocks are all decreasing? Like, is there more investors like participating in in short sales?
I'll bet that's a good question. I'll bet there are. So yeah, a short sale, like if you sell stock short, that means we're betting that the price is going to decline, right? So if I would imagine more investors, just because there's more volatility, there are more investors than usual that think that the stock market's going to decline or that certain stocks are going to go down in value, so they short them. And then, but like in the context of portfolio management, it would be really weird to be short like an entire asset class.
Yeah.
If I do, I'm just going to short the whole non-US equity market. That'd be strange to have a negative weight on a whole asset class for most investors. But there's folks out there who, are shorting individual stocks and trying to make money that way. But it's risky because the most you can lose from a long position, right? If I buy a stock, the most I could lose is 100% because I buy the stock, it goes bankrupt, and then the stock becomes worthless.
Mm-hmm.
So, but with the short position, if you short a stock, the amount of money you can lose is unbounded by bankruptcy, right? Because if I short a stock at $10 and the stock price goes up to $15, I've lost 50%, right? Because I make money when the price goes down. If the price goes up, I've lost 50%. If the price goes up to 20, I've lost 100%. If If it goes up to 30, I've lost 200% on my short investment. So you can lose a lot more money in shorting.
Okay. And my next question was, because I find it like I don't know how it actually works. Like I understand that you borrow it,
Mhm.
but how do you like sell it? Because obviously if you buy the stocks, then you have to like get rid of them and then buy it at a later date. So how do you get rid of the stocks that you just borrowed?
That's a good question too. So it usually happens through a broker. Like, let's see.
So is it hard to do that, like to sell them, or is it easy to do it?
It's not hard to do. Let's see. If we open up Yahoo Finance, and pull up a company. Let's see. You got a company that you think is going to go down in value in the near term? What stock would you short if you had to pick one to short?
But you can do the GE from personal finance.
Yeah. Okay. All right. That's a decent one. Yeah, we're banking on that mass contract with Ford. Let's see how they're
Good choice on that one.
doing. So right, yeah, if we shorted GE right now, the price is 693. So what happens is you borrow the stock, and then you can borrow it. Usually, you can borrow it from whatever broker you trade through. So if I use Robinhood to play around with stock trading, so I can short stocks through Robinhood, and you borrow shares of stock from Robinhood. They find it from somewhere else. Either they hold it or they find an investor that's willing to lend it. So you borrow the shares right now, and then and then when you short them, you just sell them at whatever the market price is right now. So you put in like a sell market order, and you've sold the stock that you've borrowed right away. So that it's like you borrow something and you sell it instantly, and then you get the cash from that.
Oh, so you get it's an instant that you borrowed it and you sell it right away.
Yeah, pretty much right
Okay.
away. Yeah, those things happen consecutively and really close in time to one another.
Mhm.
And then when it comes time to close out the short position, you buy back the stock. And so the price, if GE goes down to $3, well, I sold something for almost $7, and then I bought it back for only $3, so I made $4.
Mhm. Is there a certain time limit? Because I was reading on Investopedia or whatever, and they were saying, is there like a certain time for it or no? Or you just make up the time limit, like
Um,
when you should buy it back?
the way it works is you pay interest on what you've borrowed on the value of the stock that you borrowed to the broker, for example. So if I borrow the shares of stock through Robinhood, I'll pay interest to Robinhood. And then,
So you can do it through Robinhood?
yeah,
Okay.
careful. I wouldn't recommend it. You lose a lot of money if you, but yeah. And so what happens is Robinhood will keep, if they know I have a short position in GE, they'll keep track of the price of GE stock. And if they see the price goes up to $20, then they'll say, okay, you borrowed this stock from us, and you got 693 or 697 for it, and then you're on the hook for like $20 a share. So can you give us can you set aside some cash in your account with us so that we know that you can cover this short position when it comes time to close it out? So it's not like, it could be unlimited amount of time that you borrow the stock, but you end up having to you pay interest on what you borrowed, and then also you have to prove you have enough cash to cover the short position too over time.
Okay.
So, yeah. Another way to make money on stock prices going down, which doesn't have all the downside risk, is you could buy a put option. So buy an option to sell the stock, and then you can make money when the stock price declines. But anyway, that'll be actually, we're talking about options later in the course, so we'll plan to talk about that. Any other questions? Things folks want to talk about? Your class is going all right? So. All right.
Yeah.
Well, speaking of options, there's a valuable option that y'all have as students right now. So at the end of the semester, when final grades come out, you have the option to choose to earn the course grade you get, or just take a course pass fail, like take a credit, no credit. So limits the downside on the GPA impact, I suppose, which I guess it's nice, but that's still, I'm sure it's still stressful in like a different learning environment. So great. Well, whatever I can do to help you out, definitely feel free to get in touch, okay? And then we'll see you on Tuesday morning and Tuesday evening for more financial modeling and financial planning for most of us.
Thank you.
All right.
Sounds
Thanks,
good.
everybody.
Thanks.
Have a
Appreciate
nice
it.
day, Professor.
See ya.
Have a good one.
Professor.
Have a good weekend.
Bye. Thank you.
How you doing, Professor?
Good. I'm gonna get. I saw your email. I'm gonna get back to it today. Okay.
Okay, yeah. I was gonna say if you wanted to just talk about it now, or do you want to just take some time later?
Let me take a look at it later today. I've got. There's kind of a lot going on during the day, but I will get to it. So.
Oh, yeah, cool. Yeah, no problem. Sounds good.
All right. Thanks for. I'm glad you're on top of it. I saw you've registered for some classes, so I appreciate that you're on top of it. But I'll get to it for sure.
All right, cool. Thanks, Professor. Appreciate it.
Thank you, Michael. See ya.
Have a good one.